Every day you work for money. You wake up, go to work, make decisions, pay bills, buy food, and save what you can. Money feels personal. It feels like something you control. But there is a hidden reality most people never think about. The value of that money is not entirely in your hands. Somewhere behind the scenes, decisions are being made that quietly influence how much your money is worth. When prices rise, when loans become expensive, when savings lose purchasing power, those changes rarely happen by accident. They often begin in a place most people never see. A place where interest rates move, money is created, and economic pressure spreads through the entire system. The question is simple, but powerful. Who controls your money? To answer that, we have to look at the system behind the system. Because once you see it, the economy starts to make a lot more sense. Money feels natural. You earn it, spend it, save it, invest it. From the outside, it looks like a simple system where people exchange value with each other. Businesses sell products, workers receive salaries, banks lend money, and governments spend money on services. Everything appears to move naturally, almost like a self-running machine. But money itself does not manage the economy. Someone manages the money. Think about it. Governments decide how much to spend. Banks decide how much to lend. People decide how much to consume. Yet, above all these decisions, there is a system designed to influence how money moves through the economy. A system that can slow spending, encourage borrowing, or suddenly make money easier to access. Most people interact with money every day without asking a deeper question. Who decides how much money exists? Who influences how expensive loans become? Who steps in when inflation rises or when economies slow down? Behind the scenes, there is an institution with exactly that responsibility. Not a government ministry, not a commercial bank, but something more powerful inside the financial system. Central banks present themselves with a simple mission: maintain price stability, protect the currency, keep the economy functioning smoothly. On the surface, the goal sounds straightforward: prevent inflation from rising too fast, and prevent economic collapses when markets weaken. But the real question is not what central banks want to achieve. The real question is how they actually do it. How can a small group of policymakers influence an entire national economy? How can decisions made in one meeting room affect mortgages, business loans, job creation, and the prices people pay at the grocery store? The answer lies in a set of powerful tools that central banks use to shape the flow of money across the entire financial system. These tools do not control people directly. They influence incentives. They change the cost of borrowing. They alter the availability of money. And when those conditions change, the behavior of millions of businesses and consumers begins to shift. To understand how central banks control your money, we need to look closely at the first and most powerful tool they use: interest rates. Interest rates are often described as the price of money. When central banks change this price, they change how easy or how expensive it is to borrow. And that single adjustment can move the entire economy. Imagine interest rates are low. Borrowing becomes cheaper. People feel more comfortable taking loans to buy homes, cars, or start businesses. Companies invest more, build more, hire more workers. Spending increases, and the economy begins to grow faster. Now imagine the opposite. The central bank raises interest rates. Loans become more expensive. Mortgage payments increase. Car financing becomes harder. Businesses hesitate to borrow for expansion. Spending slows down across the economy. This is not random. Central banks use interest rates as a control dial. When inflation rises too quickly, they increase rates to slow spending. When the economy weakens, they reduce rates to encourage borrowing and investment. One small change in interest rates spreads through banks, loans, businesses, and households. The result is that spending behavior changes across millions of people at the same time. In other words, interest rates control how fast money moves. There is another tool that surprises many people the first time they hear about it. Central banks have the power to create money. This does not mean printing stacks of physical cash every day. In modern economies, most new money appears digitally inside the financial system. Central banks can create liquidity by purchasing financial assets, usually government bonds, from banks and financial institutions. Here is a simple way to understand it. Imagine an economy that has 100 coins circulating between businesses and consumers. That amount of money supports a certain level of activity. People buy products, companies invest, and prices stay relatively stable. Now imagine the central bank injects more money into the system. Suddenly there are 150 coins circulating in the same economy. But the number of goods and services has not increased at the same speed. Now more money is chasing the same products. When that happens, prices begin to rise. Central banks often use this tool during economic crises to stimulate activity. By increasing the money supply, they make borrowing easier and encourage spending and investment. But this power must be used carefully, because too much money entering the system can weaken purchasing power. And that is when inflation begins to appear. Central banks do not operate alone. Their influence spreads through the entire banking system. Commercial banks are the institutions that actually lend money to businesses and consumers. They provide mortgages, car loans, business credit, and many of the financial products people rely on every day. But these banks operate under rules and conditions shaped by the central bank. One of the most important mechanisms is the banking reserve system. Banks are required to keep a portion of their deposits as reserves instead of lending it out. Central banks determine these requirements and supply liquidity to ensure the system remains stable. When central banks tighten financial conditions, banks become more cautious. Credit becomes harder to obtain. Businesses delay expansion. Consumers postpone large purchases. When central banks loosen conditions, banks have greater access to liquidity. Lending increases. Businesses invest. Consumers borrow and spend more freely. In other words, central banks influence how much credit flows through the economy, and credit is one of the main engines of economic activity. Through this system, the central bank does not lend to everyone directly. Instead, it shapes the environment that determines how money moves from banks to businesses and from businesses to consumers. This is how central banks control the flow of money. Once central banks adjust the flow of money, the effects do not stay inside the financial system. They spread through the entire economy. It often begins with a single decision. Interest rates move up or down. Credit becomes easier or harder to access. That one change begins a chain reaction. When borrowing becomes cheaper, businesses invest more. New factories are built. Companies hire workers. Income increases and consumers spend more. As spending rises, demand for goods and services increases, and prices can begin to climb. When borrowing becomes expensive, the opposite happens. Companies delay investments, hiring slows. Consumers cut back on large purchases. Demand weakens, and economic activity cools down. This is the domino effect of monetary policy. A decision made by a central bank can influence mortgage payments, business expansion, job creation, and even the prices people see in stores. Real estate markets can heat up or slow down. Stock markets can surge or decline. Inflation can accelerate or begin to stabilize. All of these outcomes originate from adjustments in the cost and availability of money. A small decision at the center of the financial system can create millions of consequences across the entire economy. Central banks were created with a clear objective: keep the economy stable, prevent inflation from spiraling out of control, avoid financial crises that can destroy jobs and businesses. In theory, their role is to protect the balance of the economic system. But stability requires influence. And influence means power over the most important element in the economy: money. When central banks change interest rates, borrowing behavior changes. When they expand the money supply, purchasing power shifts. When they tighten credit conditions, investment slows across entire industries. These decisions shape how fast economies grow, how expensive loans become, and how much your savings are worth in the future. This leads to a deeper question that most people rarely consider. If someone has the power to influence the price of money, they also influence the value of everything that money can buy. So the real question becomes this: if central banks control the conditions that shape the value of money, how much control do we truly have over the value of our own wealth? Money moves the economy. Every product produced, every salary paid, every investment made depends on the movement of money through the system. Businesses rely on it to expand. Consumers rely on it to buy. Governments rely on it to operate. But behind that movement, there is another force shaping the direction. Central banks move money through interest rates, money creation, and control of the banking system. They influence how much money circulates, how expensive it is to borrow, and how the economy responds to growth or crisis. This influence does not happen in dramatic headlines every day. Most of the time, it works quietly, through policy decisions that ripple through banks, businesses, and households. Yet, those decisions determine something extremely important: the value of your money. Understanding how central banks operate means understanding why prices rise, why borrowing becomes expensive, and why savings sometimes lose purchasing power. Once you see how the system works, the economy stops looking random, and money begins to make much more sense.